Thanks for tuning in to this episode of the Resilient Advisor Show. My name is Jay Coulter, and joining me for this episode is Chris Winn, the founder and CEO of Advisor Assist, and we are going to talk about some new initiatives that have come out from the SEC and what implications they could have for your business.
Our mission at Resilient Advisor is to have a significant impact on the retirement crisis by educating and empowering financial advisors to better serve their clients. We bring you industry thought leaders and experts to help you make a difference in the lives of your clients.
Are you struggling to hold your team accountable? Do you struggle getting them to see your vision and drive results? The Resilient OKR system for financial advisors could be your solution. OKR is an acronym for Objectives, which are your big inspirational goals, and Key Results, which are how you and your team are held accountable. This is the Silicon Valley method that drives growth at major companies such as Intel, Google, BMW, and Disney. Move your business results away from opinions and measure it with data.
Pick up your complimentary access to the Resilient OKR system for financial advisors by visiting resilientadvisor.com/OKR.
Chris Winn has become a regular guest on the Resilient Advisor Show. And in fact, our last broadcast on the updates from the SEC as it relates to the marketing rule was one of our most watched episodes because, Chris, you really come with some great information and guidance for advisors on these important topics. I received an email from you at the beginning of the month laying out some initiatives that the SEC will be looking at this year. And I appreciate you coming on to talk these through with advisors. Before we get started, could you give us some context for why they send this out, how regular this happens, and what advisors should be looking for?
Excellent, Jay. Thank you for having me again. So the SEC, has a really tough job. The number of registered investment advisors increases significantly on a rolling basis, and they have their limited resources to get out and review and examine all the different firms. A number of years ago, they realized that they were getting killed in quoting percentages. So they used to quote and how many percentages, the percentage of exams that they would get out to and review. Of course, with an increasing denominator, that makes your numerator look smaller, right? So the challenge that they had is how do we make this more of a risk-based approach, and how do we get the industry as a whole to help us be more efficient in doing our jobs as regulators, their jobs as a regulator. So they started by, creating a number of initiatives in terms of the way they handle exams. But one of them is to demystify what they're looking at. So instead of the classic, I'm not going to tell you what I'm looking for, I'm just going to wait till I can say I gotcha. They said, why don't we let everyone get ahead of it and start to understand, here's where we see the risk. And as fiduciaries, which most registered investment advisors are complete fiduciaries, here are the things you need to be thinking of. So generally each year, around the start of every year, they release their priorities, the SEC's priorities for their examinations, where they're going to spend their time in helping the advisors to make sure that they're performing their own self-assessments or risk assessments in those particular areas. And this year we're a little late in it, given the being that it was an election year and the general character of everything that was going on in Washington. So generally they're a little earlier in the year. Usually I'm having these types of conversations in the January timeframe. But given the timing of when this came out, obviously, everybody's getting to it as quickly as possible here.
Yep. And there are 11 priorities that we're going to talk about today. If you're watching this broadcast live on Twitter, Facebook, YouTube, or LinkedIn, feel free to chime in if you have any questions, and Chris will answer them to the best of his ability on a live broadcast. But also, if you're watching this on replay on YouTube, there's a new feature now where I will break this down by chapter for each one of the 11 priorities. Chris, let's dig in. The first one is fiduciary care.
Absolutely. So the fiduciary responsibility of a registered investment advisor is nothing new. But what the SEC did to bring it right up to the forefront is kind of re-informed the advisors as a whole as to what does fiduciary duty really mean. And in true SEC form is, if you can't prove it, we're going to assume it didn't really happen. And so let's dig into it. Section 206 of the Advisors Act defines the fiduciary duty and responsibility of an advisor. And it's a term that's used very heavily throughout the industry. But what does it really mean? So it's great, we can throw it out on our website saying we're a fiduciary, we put you first. Well, what's from a practical standpoint, how do you in fact put people first? What are the things that you do as a fiduciary in your day-to-day management of client assets, your decisions that you make with clients, the other supporting business activities you have to avoid any conflicts of interest? So it's really the key that what they're looking for is to avoid the conflicts of interest, and of course have a way of mitigating, if there is any conflict, what are you doing about it?
We could do a whole episode on fiduciary duty and fiduciary care. Clearly, it's a priority that they're looking at this year in the examination process. The second item is Form CRS, which, if this is a surprise to you, you need a new compliance consultant.
Excellent. Well, so Form CRS is the client relationship summary, and the SEC made a requirement for the CRS to be provided to clients at the start of a relationship, but also to be included with the advisor's website if they have one. And the CRS is intended to really define what the relationship looks like with the client, any major conflicts, how does an advisor charge for their services, and generally what to expect. And one other thing that's unique about it is that if any person in the firm has anything disclosable on their at the firm level or in their U4, it requires it's a yes or no answer with no explanation. It drives you to the site. And what they're trying to get people to do is to go do due diligence on the advisor at investor.gov, so the SEC website.
That could create a challenge for some of these aggregators that might have some IARs with some dings on their U4, wouldn't you think?
Well, without a doubt. And unfortunately, that whole system itself needs some repair. There's a lot of things that are on U4s that shouldn't be out there. And sometimes it's tough to see the items that are actually issues in a sea of, potential items. So is a client complaint really necessarily mean an advisor did something wrong? No. If the advisor has, 4, 5, 6, 7 of them, can you look at it and say, well, we got a trend? Perhaps. So it's tough. But with, certain, states and others where you see billboards out there saying, if you've ever lost any money in the markets, give us a call and we'll come shake down your advisor for you. It's a broken system. And so there's reporting out there that's unfair. But if you look at it from the other side, the regulators say obscuring the information isn't fair either. So that's why they're saying, yes, no answer, and then let the tool that's designed for the disclosure speak for itself and bring it to that level.
Another priority that they rolled out this year is around conflicts of interest. What are they looking for?
Well, it ties right into your fiduciary duty, but the conflicts of interest can be ranges the scope of an advisory practice. So, for instance, even a firm that for instance, does financial planning, and at the end of the plan recommends that they continue to work with the advisor, arguably it's a conflict of interest. But of course, no advisor is going to do a financial plan and say, you shouldn't come work with me, you should go somewhere else, which was the whole nature of why they were doing it. But conflicts take on many forms. It's, do you have affiliates or relationships? Very common is, are you also a hybrid, a registered representative of someone's broker-dealer, or do you have your own broker-dealer? Do you sell and offer insurance? Do you sell and do you offer tax and accounting services, or sell mortgages? All of those things are potential conflicts of interest. And even one I was dealing with earlier today, someone who's fully employed elsewhere, but trying to create an advisory business for the future, well, technically there's a conflict of your time. So when are you actually available to be my advisor if you have another career? So there's a number of ways of looking at that, and the regulators want to make sure that conflicts are fully disclosed. So, is there, are you investing in the investment strategy for which you are have an ownership interest or another financial interest, or are you referring business to someone who has you have a vested interest in the success of the other firm? All of those types of items, represent a potential conflict of interest, and the regulators want to make sure that we're actually disclosing those.
So, Chris, another priority that they issued, I feel like has been on their list for a while, and that's around advisory fee billing. Are there any changes to what they're looking for this year?
Well, yes. Well, in terms of, it's not so much that they're looking for anything different. It's that they found in their examinations that a lot of firms weren't as tight with the rules as they were expecting. So the rules haven't changed. And a very common thing, for instance, is a client that terminates within a billing period. And did the firm properly calculate a refund due to the client, timely process that refund, and actually get the money back to the client? And they cited many instances where it was inconsistent. So firms would sometimes do it, but sometimes forget. The calculation was not always accurate. So when is the effective date of termination? And having tracking and methodology around all those components. So that was one of the biggest things. The other major thing, which could potentially happen to any firm, is the actual calculation methodology itself. So many firms are leveraging either the custodian or a pricing vendor to obtain their pricing, and of the securities in the portfolio, and then they may be either calculating themselves or using a software. And I won't use anyone's names or any of this. But if the software, for instance, isn't set up to appropriately calculate the fee, then obviously the fee isn't going to come out right. If there's a contractual breakpoint in the fee and the advisor didn't set up the system to hit the breakpoint when the the client account hit $1 million, or the aggregation of all of their accounts to meet the breakpoint, those types of things can result in a misbilling of the client assets. And even the application of things that would seem simple, such as accrued interest. Does a billing period end on a Friday or a weekend? As opposed to the middle of a week. So those types of things of what's in, what's out of the math is of importance. And what they found from examinations is that as an industry, there's been a lot of gaps. So not everybody is as tight as they should be on that.
Yeah, I mean, it's very complex going out and calculating that, more or less keeping track of it and running your advisory business, which is a real risk for advisors doing this on their own.
Absolutely. And we have a testing service that we do, but also to help do sample testing on it, but also teach our advisors on how to recalculate and do sample testing. So part of it is, it's not so much, perfection is great, but having a process that sets you up for the ability to capture potential deviations is mostly what they're looking for. So it's, so if you don't do it, then we know what the answer is. Well, you can't possibly know if you've ever miscalculated a fee if you've never looked.
Right, right. Well, let's use that as a segue here. We have a handful of priorities left to still go over, but would you tell listeners and viewers a little bit about Advisor Assist and the services that you guys offer?
Certainly. So Advisor Assist helps advisors in two real distinct phases of their life cycle. On the initial startup of a firm or someone who's contemplating creating a registered investment advisor, we help them with the strategic design, build, and transition into their RIA. So essentially helping them from concept to live, helping them extract themselves from their current situation in a safe manner and properly get up and running to help help transition all of their clients over into their new registered investment advisor. Then once they're up and running, we have a suite of services that we help them in what we call risk management. And instead of just considering compliance, we look at it in the broader sense of compliance is one leg of the stool. We need to look at not only the regulatory environment, but the external threats like cybersecurity, the processes and workflows and the use of your technology to help create a risk managed business. So regulators are just one component of all of that there. So with that, we have structured compliance programs to essentially guide them through their year in compliance. And depending on the size and complexity of the firm and the resources that they have, we can either do things alongside the firm or we can do it for them. So as I mentioned moments ago, we have our core compliance, but where we're administering the compliance program and keeping all the policies and procedures up to date and ADVs filed. But we can also take some of the burden off of the CCO to dive in and do the actual testing. So the fee billing that we just described is a service where Advisor Assist can actually go gather all the data, have read-only access into the systems, and do all those calculations and validations for them as well. And really the goal is to keep them as audit ready as possible. And we have a technology we built called Advisor Cloud that not only helps us collaborate with everything, but it essentially gives us the audit trail. So when the audit does come, we have the a full feed of everything that's been done to help the advisor and what they've been doing on their own to prepare for compliance.
Excellent. Chris and I have a lot of joint clients. I've been on that system before. It helps an advisor manage their compliance process. But I'm telling you, if you're listening to this because you're considering a breakaway from your wirehouse or your broker dealer and going independent, I find that most advisors are getting their information from either custodians or recruiters, even worse, recruiters at aggregators. And that is not the best place to start. Whenever I have somebody reach out and they're ready to do a break, I'm not a recruiter, and I start with Chris Winn and his team, and they set the table for what they need to think about as you go through the breakaway process. And Chris, you and your team do an excellent job of that.
Oh, thank you very much, Jay.
All right. So the next priority we should talk about is the appropriateness of investment advice. What are they looking for this year?
Well, again, this is not a new topic, but one where if we tie it back to fiduciary duty, saying you're fiduciary and then having something to prove and demonstrate it are two completely different things in the eyes of the regulators. So with the appropriateness of investment advice, they're looking at gaining a full understanding of the client and their situation and making sure that your investment advice is either tailored to the client or you are only managing the portion for which is fitting of your strategy. So the SEC is mandating that the firm conform their strategies always to a client. But for instance, if you have a small cap strategy and your strategy is run the same way for everybody, well, perhaps 100% of one's assets shouldn't be in that strategy. If you're a wealth advisor and you are crafting an overall portfolio for them, they're looking for, well, what is the due diligence that you are performing, initial and ongoing, to determine not only what, where the client's, suitability, their risk tolerance, time horizon, fit, tax situation, et cetera, all tie into the investments. So really just making sure that all that advice is aligning with the client's situation. And quite frankly, that they're looking for proof that the advisors are continuing to earn their fee. So a really good analysis on the front end to craft a portfolio, and then just looking at it once a year, the regulators would say, well, you don't meet the definition of assets under management. It's neither regular nor continuous if you're only looking at something once a year. So it's kind of bringing all these concepts together, and they're just trying to find a way to bring this to the top so that everyone understands it's a focus area.
Yeah, I've run into that situation with wirehouse advisors going independent, and they've been able to sit in those portfolios that they set it and forget it, and then they go to the independent space, and meeting that requirement is a new challenge for them. Is that something common or just what I've run across in my work?
Well, it's fairly common. It is a little bit more common from those that are coming out of a wirehouse environment where they were in advisory programs where someone else was the portfolio manager for the program, and the advisory person was handling other complementary advice components, so financial planning and which programs to be on, which managers to utilize in a program, but not so much the specific security recommendations. The SEC was intentionally broad here in that they're not trying to craft people's advisors' portfolios for them. They're not trying to tell them that you can't use alternative investments. They're not trying to tell them you can't use options. They're not saying that you have to use direct investments and can't use independent managers. What they're saying is that it needs to be appropriate for the client, the situation, and that has everything to do with, asset size, time horizon, risk, what you're going to do, the effort you're putting in as an advisor versus what you're delegating out to third parties. And really the key thing is it's a shift. So for instance, take whether all or a portion of a client's account gets allocated out to investment managers, other advisors on an investment platform, or a direct sub-advisory relationship. Those things are still okay. It just is a shift in responsibility. So if you're the one that's if you're doing internal management and you're the one that's doing the specific trading and security selection, you have a different set of activities than if you're supervising somebody else that you've delegated that to. And really the key that they're coming to is to say, just because you've delegated to someone else that's supposed to be an expert, you have a responsibility to now due diligence on them to make sure that they're consistent with the investment mandate on a perpetual basis.
And does implementing an investment committee take care of this most of the time?
Well, it certainly helps, right? But the challenge, of course, is it depends on the size of an advisor. Some smaller firms have an investment committee that may include somebody that's external to the firm, whether it's an advisory board member or one or more members of a platform for which they are receiving research, analysis, and other components. So it doesn't always need to be, a specific named investment team within a firm, but it shows well. The challenge, of course, is if you say that you do something, you got to actually do it, right? So having an investment committee is only as helpful as having consistent review of investments and documentation of committee minutes and meetings along the way. So the SEC looks not only for the things that you aren't doing, but the things that you say you do but don't do. So it's a very important thing that you brought up.
Yes, yes.
Our mission at Resilient Advisor is to have a significant impact on the retirement crisis by educating and empowering financial advisors to better serve their clients. In the new Resilient Advisor series, How I Serve, we interview top financial advisors who are making a difference in the lives of their clients.
All right, another priority that they're looking at this year is sustainable investing. What do advisors need to be mindful of?
Well, I guess one of the key things that first comes to mind, and it's not core to ESG specifically, but hypothetical performance is an area that that immediately first comes to mind. In that a lot of anytime there's something that is a new trend, there's those that are on the forefront of that, and those that are moving along with the momentum of it. But the challenge is that there isn't a lot of actual documented track record or history for a particular firm, especially if they're creating a new investment model. So first is full and fair disclosure around all of this. So with these, making sure that making sure that all of the marketing and advertising is truthful, accurate, and doesn't omit any material fact is important. So sending out a fact sheet talking about your track record on your sustainable portfolio, and showing a 10-year track record, but failing to mention that you've been in business for 9 weeks is not, would be basically a violation by omission in that regard. So those are the things that they're mostly looking for. The other is getting into, does the firm get into proxy voting, and what is their advocacy, and how does how far does the portfolio extend? So it really hits those core advertising principles, in my opinion. Otherwise, it's no different than any other investments. So, is it truthful? Is it accurate? Are you failing to include all material facts as part of your approach and communication?
Yeah, those ESG back tests infuriate me because it's easy to go and throw Tesla and Apple in there, and anything looks good when you add that to a portfolio mix the last couple of years. All right, another priority that they're looking at, and I have seen this directly impact a lot of my clients, and that's cybersecurity and business continuity, especially after COVID-19. The attacks are out there. What are they looking for?
Well, I mean, obviously, the fraudsters are out there looking for vulnerabilities, and especially think of it this way: is a fraudster going to go head on with a major financial institution like the major custodians of this industry and try the front door, or are they going to try to get some help going in the back door? And that's exactly what's happening, from the phishing attacks and trying to control computers. And even think of with all of the pandemic and working from home. If you're a fraudster, are you going to try to go in and find a way into the encrypted, secured MacBook Pro, or are you going to try to get in the back door from Xbox or one of the other gaming systems to get on a network? So there's a lot of vulnerabilities that are out here. The fact that we're all dispersed and decentralized for the past year adds to it. So we've strongly advocated that our clients reach out to their technology firms and get checkups, and in many instances we've recommended that they go get separate secure networks and bifurcate the family stuff from and the other devices from the true business devices if you're going to work from home, which may seem daunting, but it's actually can be a very inexpensive setup. It's all you really need to do is just create a sub network, and there are a number of really good cyber firms that are out there. They're asking the questions, and we know that they're asking the questions because we're indirectly getting the questions from our advisor community, asking how much of this makes sense, and is some of it overkill, and so forth. And we're helping them distill that down. But the regulators are looking at it from that same perspective. It's both the cybersecurity and the business continuity. How do we ensure that we're not making or doing workarounds that make us more vulnerable because it's too inconvenient to log into a network or systems, or there's no one monitoring your home network, except for your children who are looking for the full bandwidth for Xbox, right? So
that's right.
That's the key thing. And separately on business continuity, is your policy in your workflows, are they realistic? Do they work? Did you prove that they worked? So firms, we've always encouraged firms, and we assist in helping them do their business continuity testing. But essentially, we've just completed 375 plus or more days of national business continuity testing here, right? Since many things started to close down. Well, did those policies get updated? Were any things that were workarounds? Did they become part of the standard operating procedure? And are there controls in place? Are we, if the folks are using computers off the network, is there something to ensure that they're not ending up locally on a laptop, and and that we're not, doing double duty with the business laptop with, kids jumping onto a Zoom call for school, right? Those are the things that are, that are really important. And I think the biggest thing here is the SEC is more asking than telling. And what I mean by that, they want to understand what everybody's going through more than just going out and telling everybody what their expectation is. So they're asking a lot of questions, and they're probing questions, which tie into fiduciary duty and books and records. And so while there isn't a specific rule to reference, the SEC is going back to the fiduciary rule, saying, well, wouldn't it be reasonable as a fiduciary that you'd have strong security and cybersecurity controls in place? And you have to nod, well, yes, I guess that would make sense as an advisor. As the chief compliance officer of an advisor, subject to Rule 20647, you're required to have a compliance program in place to prevent any of these issues. Wouldn't it be reasonable then that you have a cybersecurity policy and that you test it? I'm like, okay, yes, you've got me there. Okay, great. Well, now show me all the things that you've been doing to adapt your policies and procedures and to do the testing, given that you're in this new environment. And that's where they're finding the weakness there is everyone, we're seeing a lot of advisors saying, well, I have a business continuity plan. It says I can work from anywhere at any time. Okay, well, now you're working from anywhere at any time. Does it need to be evolved? Are you doing things exactly the way you conceive them, you know, when you wrote your policy 3 years ago? Or is there something that's new and different that you need to be thinking about? And that's what they're getting at. They're really trying to, you know, not just hit the nuts and bolts of making sure customer accounts are safe and that information is safely and securely in the advisor systems, but just make sure that that if there is an incident, are we going to ignore it because it happened at home instead of happening at the office? You know, is there proper escalation procedures and, you know, all the protocols? So it is, we could spend 2 shows on this one just in and of itself. And quite frankly, this is the biggest risk. So they put it, you know, in the middle of the pack in terms of what they're focusing on, but arguably this is the biggest risk advisors have out there. And requires a fair amount of attention.
And you know, Chris, I'd also add to people listening, and if you're still listening 30 minutes into a show on SEC priorities with a compliance expert, you probably already have this covered. But just in case you don't, check your E&O policy and see if you're covered for cybersecurity attacks. I have seen it create amazing havoc on financial statements for some of these advisors. So check with your E&O broker.
That's actually a very great point. And really quickly to add to that is look up how they define negligence. So if you have a cyber event and you continue to listen to the end of this session here, are you now negligent for not stopping what you're doing and going to take corrective action? So is it time bound? You know, are there any events that aren't properly disclosed that, you know, insurance companies aren't out here to pay, right? They're going to look for every reason why it should be outside the policy. So you need to make sure that you're, you know, ironclad on those in terms of your internal approaches and make sure your policy is actually working for you. So if you're paying for a policy and you can never use it, then it's an automatic loss.
Right. So Chris, another priority are automated compliance software systems. Do you know what they're looking for on that this year?
Absolutely. So a lot of the portfolio reporting systems have added a lot of compliance functionality. And part of the key thing is they're looking for leverage of technology to bring things to an exception-based process. So recognizing that there's only so many hours in a day, if you're looking at a full universe of everything, can you find an issue in a sea of trades? Or, you know, if you look at every one of your client accounts at once, so you're going to find the account that needs attention, that, you know, the firm that needs rebalancing, the account that has high cash or low cash, the one that didn't get traded at the, you know, and get left out of a block trade. So what they're really looking for is to leverage the technology that's out there to filter these things so that you have different lenses of your view. And from a compliance standpoint, you can look at these and call this all a cost and look at everything after the fact. So go back at the end of each quarter and have your compliance consultant or your operations team go and look at all your trades, or you can bake it into your day-to-day investment management process and risk oversight. So what reports do you look at as a portfolio manager, you know, an advisor to your clients? The technology allows you to just adapt the reports that you're looking at and see some of them that are exceptions that meet certain criteria. And by, you know, we think, a healthy suite of these reports that are accessible on a regular and routine basis to the advisors make them better advisors. So it's not just about, you know, catching the trade error or seeing if a client account wasn't traded as quickly as possible, but more, you know, looking at opportunities to connect and talk with the clients, or looking at risk across the enterprise, and truly knowing the client base, knowing knowing the universe of investments. So these technologies are coming; they're leaps and bounds better than they have been in years past. And we're seeing advisors really get the most out of them. And again, they're paying well for those systems. This just gives a mechanism for really getting the most ROI out of that spend.
Yeah, and I don't want to name any names, but I've been sitting in on some demos recently, and they kind of let me look behind at some of the beta things they're doing, and it is pretty cool, the type of reporting they can give you or will be able to give you in the very near future.
Absolutely.
So another priority is around digital assets. It's a hot topic.
Yes. Well, this is a extremely hot topic. We could spend a month on this one. The challenge with a lot of the digital assets that are out there really stem in the journaling and the risk controls, and who is policing who in what regard. It's all evolving at a very rapid pace. But the various market participants that are here, no one wants to be left behind, but at the same time, there's a lot of unknowns and a lot of risks. So, first going back to your E&O, are you even covered if there was ever a mistake with digital assets? How do you report on it? How do we know that if we're, going back to the prior topic of automated, compliance systems, how do we know, how do we get the real-time data or near real-time data on all this information to know that it's fitting and tying into the suitability of a client portfolio? So there's just a lot of unknowns. How do we trust the pricing? Is there any, so who is, where is the authoritative pricing source, and is the authoritative pricing source, legitimate in and of itself? So it's really, it's a fascinating area, but the challenge is that there isn't a single ownership of it. And so that's what makes it, a bit of a challenge where, if you have for instance, we'll take something very simple. You have an open-end 40 Act mutual fund that prices at the end of the day. The price at the end of the day is the price at the end of the day. And it's the same for everybody. And that is, that's all long since been baked into processes and controls. With all these digital assets, is it, when does it actually close? What's the timing? When do you value it? So if you're billing a client and you went to go get a cup of coffee at month end, when you came back, the price was materially different. What price do you use to bill a client for your services? So there's just all these unknowns that are out there. We continue to, track it in great detail, because not only is there a great demand to understand it, but it takes all of the rest of the issues or topics of the industry and rolls them all into this one topic, because it's almost like starting over in this new reality and trying to figure out how all the other controls tie into this.
And when you dig deeper, and I've had a lot of folks that are experts in the digital asset space on the show, and really I brought them on from my own educational experience. Boy, they're smart people building really incredible platforms in this kind of Wild West component. But man, we could wake up one day, and if we're not paying attention, this is a big part of our industry. And, there are folks that aren't going to want to get left behind, but I have a feeling there are people that are going to get hurt in the process by not following the rules. And I know advisors are giving advice on it when they should not be. And the education that's needed for what they can and cannot say and can and cannot do has never been more important.
Without a doubt. Yeah. And that's why, again, tying it back to fiduciary duty and suitability. If your client is, for instance, Mrs. Smith as a 75-year-old widow, and you're having this conversation about digital assets, it's probably something wrong. However, that isn't universal, right? So it could be, it could be the wealth of Mrs. Smith, and she could be trying to generate substantial wealth for her grandchildren. So it's all these things where all these factors have to come together with a fact pattern to determine, not only what's right or wrong, but also how do you manage and mitigate the risk of any decision? You
know what, Chris? This will make a great clip. So here's a hypothetical situation. You're a fiduciary advisor at an independent RIA. You're doing your annual review, and the client says, oh, by the way, I've got, $1.5 million in crypto over in Coinbase. You now know that information. Does it need to be included in their plan? Do you account for it in the financial planning software? Do you talk about it at all? What's the approach?
Well, I think the approach will vastly different on the client, their situation, and what the intent is for doing this. So, for instance, some advisors have clients that say, here's all my wealth, but by the way, here's the carve out of my assets that I like playing around with the markets, and I'm going to always do that. And so from an advisor standpoint, we like to have the client agreements have a carve out of, non-managed, non-monitored assets. So you're not picking up liability for things that you can't control. But arguably, you can't really do your job if you don't factor everything into it, right? So it either needs to be like specifically excluded or worked around, but the extent of which the advisor is involved with it needs to be somewhat documented. Because think of it this way, one's a professional advisor, and if something is to go wrong, the simple response would be, well, I just assumed my advisor was paying attention to this. It's a professional advisor. Like,
I told him about it.
Right.
Why isn't he?
Yeah.
Right.
Exactly. So it's if there's something where the advisor can't take the risk or is and doesn't feel comfortable with that asset, we strongly recommend either an investment policy statement, a carve out in the client agreement, or even just an email documenting, look, on March 23rd, we had this conversation about digital assets, and, we feel that this is a risk area. You acknowledged my concern and said, great, I'm still going to do it. That's okay. The advisor can't necessarily stop the client from doing the things that the client has a will to do, but they can't carry unlimited risk on things either.
But you know what, Chris? Like, we know advisors, and so even ones that are operating at the highest fiduciary level. Let's say, go back to my example of they find out there's $1.5 million sitting in Bitcoin, and the corpus of their retirement assets are the same amount, $1.5 million. That could theoretically take them from a 70-30 allocation, and the advisor say, okay, we're going to move you down to 50-50 or 40-70 because of what you're holding out there. But that's giving advice into itself too. And then you still have to watch Bitcoin, and then it really creates a conundrum for advisors.
And that's why we really want that carve out to say, while we will take into consideration the risks that you and the allocation you have, we're not managing that over there. And it could be anything. It doesn't necessarily need to be Bitcoin. It could be Tesla stock, or, it can be Apple. It could be anything. If they're not managing it, and there's a price drop there, then who's responsible, right? So it needs to be clear what the advisor is doing. And think of it from the fiduciary duty that we were talking about before. It's the definition of your fiduciary duty cuts both ways. So the things that you're not doing, it's important to state what you're not doing as well as a fiduciary, so that there's no misconception as to what an advisor is doing for them and what they're not doing, and how they're earning their money. So there's a lot there, and we think that the most important aspect is making sure that if something is out of a very standard norm, that there's something in writing that helps everybody demonstrate what they were thinking, because everyone's going to draw their own conclusions, 2 months, 2 years, 5 years down the road as to what someone might have been thinking, back in March 2021.
Yep. All right, we could do multiple shows just on that. Let's move on to another priority is around compliance programs. What's the SEC thinking as it relates to that this year?
Oh, excellent. My favorite topic, so we spend a lot of time not only designing and building the compliance programs, but helping make sure that they are, that they remain current to how the advisor actually conducts its business. So they listed a number of things they want to make sure that are actually in a compliance program. And again, I use the term kind of backdoor regulation here. Notice you see some of these same things listed in the communication I sent: business continuity plans, compliance resources, sustainable investing, outside affiliations like broker-dealers, your portfolio management, safekeeping of client assets. So they're hitting a lot of the topics that some have extra definitions, some don't, but it's all intentional to be able to say, look, all of these things are important to have a risk management program. And as a fiduciary, you're responsible to be thinking of all these and have mitigation and risk techniques here. And your CCO is responsible for not only developing this compliance program, but testing its effectiveness on a regular basis, at least annually going forward. So what the SEC is looking for is, as I mentioned, business continuity. Did you update your BCP plan to show how you're actually now working in a pandemic? You start to go down the path of some of the sustainable investing, and you have a model portfolio. Does your compliance policies address how you deal with hypothetical performance and the accuracy of the data and the review of advertisements that go out? You have a broker-dealer affiliation where you're a registered rep. Where does the policies and procedures of the advisor end and the broker-dealer policies pick up? So they're looking for, no one pointing fingers saying, oh, that's outside of our scope, or, policies that are either too granular that they can't live up to them, or too broad that they don't really say anything, is kind of the core of what the SEC is looking to ensure is addressed.
Excellent. And the last priority, Chris, and this has been a big issue in my network, are items around private fund advisors. What are they looking for?
Well, they're looking for a number of things out there. So with private fund advisors, this has been a hot topic since 2005 and before. But 2005, where they first tried to create a registration of every hedge fund as an advisor. The challenge with a lot of private investments is they're taking numerous forms. So what is is something a perpetual offering by the advisor, or is there co-investing between an advisor and client? What constitutes an actual vehicle versus something that was just a legal entity to facilitate the means to an end? So there's so much that's baked into this, but what the key thing that they were noting is that a strong percentage, better than a third of the advisors out there, have some clients with investments in private investments. And that could be private equity, it could be other hedge funds, fund of funds, SPACs, and other special purpose vehicles and things that are out there. And what they're looking for is across the board. So is the appropriate back to client suitability? Is the advisor sponsoring or offering up a security? And if so, is all of the offering of that meeting all of the Securities Act requirements that are out there? Is it suitable for everybody? So the qualified client and accredited investor definitions have had some attention over the years. So does it represent an excessive proportion of a client's portfolio? So it's really all of those risk factors. But then most important, we were talking about due diligence and the oversight of outside products, outside managers, the accessibility of information. So it's one thing to monitor what's going on with Apple stock, and across the internet, every financial news site and station will give information on that. In a private investment, how do we get information, and what's the timeliness of that information? How do we get pricing and valuation information, and how do we know that it's accurate, and is it timely? So if the firm only gives you semi-annual, if the vehicle is only creating semi-annual pricing, and you have it in a portfolio, and you bill on your portfolio, and you build a client account on a monthly basis, well, what valuation are you using for 5 out of the 6 months where it's technically incorrect?
Right?
So those things are the areas where they're trying to dig into, and more rulemaking will come out of that. But this is where they're likely to do some sweep exams, and they're continuing to ask probing questions, and they're perusing through ADV data to look for areas that they have to focus on.
Excellent. Chris, I got to tell you, you make compliance interesting, and you have a great way of explaining things that even someone like myself can understand. For podcast listeners, to learn more about Chris and Advisor Assist, please visit advisorassist.com. That's advisorassist.com. And Chris, I really appreciate you coming on right here in the middle of your busy season.
Oh, thanks, Jay. Appreciate it.